Most Americans never learn how quietly money reshaped their daily freedom. One hidden financial war has defined middle-class life for generations. It never used tanks, only contracts, interest, and policy decisions. Banks promised stability while slowly changing who really held power. The consequences reach every paycheck, mortgage, and retirement account today. After World War II, America emerged wealthy, confident, and financially dominant. Returning soldiers expected prosperity, fairness, and a secure American future. Banks expanded credit, selling dreams of homes, cars, and comfort. The middle class grew, but debt quietly became its foundation. Government policies encouraged borrowing as patriotic economic participation. Savings once meant security, but credit soon meant opportunity. Banks learned Americans trusted institutions that spoke calm reassurance. Interest rates felt small but compounded powerfully over decades. Financial literacy remained limited, intentionally complex, and rarely taught publicly. The system rewarded participation, not understanding, across generations. Banks grew larger by connecting everyday dreams to long-term obligations. Americans measured success by ownership, not liquidity or independence. Monthly payments replaced outright ownership as the new normal. Stability depended increasingly on steady wages and constant employment. Few questioned who benefited most from perpetual borrowing. Advertising normalized debt as responsible adult behavior. Cultural optimism masked structural vulnerabilities beneath rising consumption. Prosperity looked shared, but leverage quietly concentrated power. Banks positioned themselves as partners, not profit-driven intermediaries. The stage was set long before most Americans noticed. Colonial America distrusted banks, remembering European financial manipulation. Early colonies relied on barter, specie, and community trust. The Coinage Act standardized money, anchoring confidence in precious metals. Gold and silver constrained power but limited economic expansion. Alexander Hamilton promoted national banking to stabilize the young nation. Financial centralization sparked fear among farmers and laborers. Boom and bust cycles haunted early American markets repeatedly. The gold rush expanded wealth but intensified speculative behavior. Banks financed expansion while assuming minimal personal risk. By 1900, industrialization demanded massive, coordinated financial systems. The Federal Reserve was created to manage instability and panics. Central banking promised balance between growth and restraint. The Great Depression shattered trust in markets and institutions. Americans lost homes, savings, and faith almost overnight. Government intervened aggressively to stabilize banks and employment. Deposit insurance restored confidence, but strengthened institutional dominance. World War II solidified America as global economic leader. The dollar became the world's trusted reserve currency. Global demand gave America unprecedented financial influence. Bretton Woods linked global stability to American monetary discipline. Gold backed the dollar, limiting unchecked money creation. Domestic prosperity surged alongside international economic responsibility. Over time, obligations strained against political and social pressures. In 1971, America ended the gold standard quietly. Money became policy-driven, flexible, and politically influenced. Banks gained freedom to expand credit without metallic limits. Inflation replaced scarcity as the primary economic concern. Wages rose slower than asset prices across decades. Financialization shifted profits from production toward speculation. Middle-class wealth became tied to volatile markets. Retirement security increasingly depended on Wall Street performance. Deregulation accelerated innovation, risk-taking, and consolidation. Banks grew too interconnected to fail safely. Crises became systemic, requiring government rescues. Each rescue reinforced banks' central role in society. Today, wages struggle to match rising housing and healthcare costs. Rent consumes larger shares of American incomes annually. Inflation erodes savings faster than interest can replace. The Federal Reserve balances employment against price stability imperfectly. Rate hikes cool inflation but strain borrowers immediately. Credit cards bridge gaps between paychecks and necessities. Student loans delay adulthood milestones for millions. Homeownership feels distant despite working full-time employment. Banks profit from fees, interest, and complexity. Financial stress reshapes family planning and career choices. The dollar's global role shields America while exporting inflation abroad. Market volatility transfers risk from institutions to individuals. Complexity favors professionals over everyday wage earners. The system rewards leverage, not patience or thrift. Middle-class resilience depends on navigating institutional constraints. Parents juggle multiple jobs while debts quietly accumulate. Young adults delay marriage, children, and stability. Homebuyers compete with investors wielding cheap capital. Retirees fear outliving savings amid uncertain markets. Medical bills trigger bankruptcies despite insurance coverage. Financial anxiety erodes trust in institutions and leaders. Communities fragment under economic pressure and inequality. Education costs burden families before careers even begin. Every generation inherits obligations created long before birth. The war remains silent because participation feels unavoidable. Understanding replaces fear when Americans learn monetary history. Transparency empowers citizens to question institutional incentives. Reform begins with awareness, not anger alone. The future depends on informed participation and collective choices. Final message: financial systems serve people only when people truly understand them.